Welcome to McGraw-Hill Financial's February Loan Market Overview Clip. I'm Steve Miller, a member of the Leverage Data and Commentary team. This month we'll focus on the loan market's red-hot technical conditions, which have pushed up secondary prices while thinning new issue yields. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. Before we start, here's our standard disclaimer. The loan market got off to a fast start in January. Propelled by strong technical conditions, prices pushed higher and new issue clearing levels sank. The market's technical strength was driven in part by record inflows into the loan mutual funds, which reached $4 billion in January, according to Lipper FMI. The other side of this equation was weak volume, with LBO-related financing disappointing in January, a theme that seems likely to continue for the rest of the first quarter. The combination of bountiful inflows and weak new money deal flow drove the market to post-credit crunch heights. The S&P LSTA index, for instance, gained 2% in January as the average loan price climbed 1.7 percentage points to a three-year high of 97.1. This chart shows clearly why the loan market has been, in the words of SportsCenter, en fuego the past few months. It's a matter of simple economics. New inflows from mutual fund subscriptions, CLO issuance, and repayments are running far ahead of M&A-related loan volume. Issuers have taken advantage of this imbalance to reprice lower existing loans and finance dividends. The impact on the secondary has been significant. LCD's flow name composite, depicted here, is a price measure of the 15 largest, most liquid institutional loans. By the end of January, the average price of this composite reached a post-2007 high of 98.2, up from 96.3 at year-end. With the markets aflame, issuers are having a field day. As the graph on the left shows, arrangers in January cut the spread of nearly half the new loans from original price talk in response to overwhelming demand. As a result, the average new issue clearing yield of first lien loans dropped to 6%, the lowest level since the new issue market reopened for regular way business in the fall of 2009. The decline was across the board, with LIBOR floors dropping, original issue discounts under pressure, and spreads narrowing. Another theme of today's red-hot market is the return of covenant-light loans. Bolstered by such big deals as Del Monte, J.Crew, and TransDigm, the volume of incurrence test-only paper jumped to 26% of overall first lien institutional loan volume in January. That compares to just 5% last year. Needless to say, this trend reflects the fact that the price of maintenance covenants is melting against the market's technical heat. As a result, many traditional loan managers that had forsworn covenant-light structures during the downturn are reluctantly re-embracing these loans as a concession to today's turbocharged technical environment. Loan default rates fell to a 33-month low of 1.5% in January from 1.9% at year-end. This puts the rate at far below the peaks of 2009 and at less than half the historical average. With the economy again on solid footing and the markets extremely liquid, most players expect default rates to stay low in 2011 at between 1% and 3%. That is, of course, unless the market is rocked by an exogenous event. Looking ahead, most participants expect the same strong technical conditions that drove the market in January to persist in the near term. Until the long hoped-for spike in LBO activity materializes or the market is buffeted by an outside shock, accounts will likely be fighting a rearguard campaign against further concessions to issuers. For now, though, issuers are firmly in the driver's seat, steering the loan market towards lower spreads, better terms, and what's rapidly turning into a broad-based repricing wave. On the plus side, default rates continue to sink as the market's overall credit profile improves in light of higher corporate earnings and vast liquidity. Well, this brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video. As mentioned, you can also download this presentation at slideshare.net.